Welcome. My name is Kristin Erickson, and I'm with North Mill Capital. We have been providing working capital to small and medium-sized businesses since 1996, and I have been there since they were 6 months old, so a really long time. I know that summer afternoons are difficult to part with, so grateful that you are all here today. Thank you for coming out. I've already learned a lot of things today. I've known Pam for years, but the one I think most important thing is I'm sending my children to her to learn the difference between needs and wants. Does everybody agree with that? Yep. So I am here to talk to you a little bit about factoring and asset-based lending. And a lot of you may never have heard of those terms. I always laugh whenever I'm out with my husband and somebody says, "What do you do for a living?" And I will say, you know, we lend money or something like that. And he says, "Well, why don't you say that you're a factor? Why don't you say you're an asset-based lender?" I said, because nobody knows what that is. So if you don't know what that is, I'm hoping that you will by the end of this afternoon. So we're going to talk about both of them. We're going to talk about what they are, how they're different than other sources of working capital, what kinds of businesses can and should use this kind of working capital, how they're structured and monitored, and then we'll talk about a couple of examples so that you can maybe get a feel for who they're a fit for and whether or not they might be a fit for you. So we've talked a little bit about this already today, but what is factoring? Factoring is the purchase of that account receivable at a discount. The accounts receivable is what Pam was talking to you about, that invoice that you've created because you sold a product, you delivered the product or the service, you've created the invoice, and you're waiting to get paid. That's that account receivable, that obligation to pay. Sometimes customers can't wait. Unfortunately, they've had to extend credit, and they can't wait that 30, or sometimes if they're selling to large companies are sometimes demanding 60-day terms. They can't wait that long because they need to make payroll, they need to pay their suppliers, they need to get more raw material in to build for that next order. So sometimes for a startup or a high-growth emerging business that may not have the historical cash flow that other lenders are going to need to see, factoring is sometimes a great tool to finance that growth without creating debt for the business or without having to go and raise equity, which is a lot of times the other alternative to this kind of financing. So how do you know, or how does the factoring company know if you're a good fit for this kind of financing? We really ask 3 questions. The first one we've just spent a lot of time discussing. Can the client's customer pay? Do they have the ability to pay? You would be shocked at how many business owners do not pay any attention to that. They are so excited to get the order that they forget if that customer can't pay for the order. As Pam told you, you not only have to replace that $1,000 order, I mean, to talk about this in a different context, with another $1,000 order, but you need to earn that gross profit margin over and over and over again until you've compensated yourself for that write-off. So this is a little funny cartoon, but I won't read it for you, but it talks about, you know, kind of the delays in the process, the excuses that businesses often provide about, "Oh, we didn't get a copy of that invoice." The reason that follow-up calls are so important. "Oh, that needs so-and-so's signature in order to get paid. Then you have to call so-and-so." So we want to make sure that our clients' customers have the ability to pay. We do provide an outsourcing for our factoring clients of that function. So we're helping them set credit limits for their customers. We're helping them make those follow-up collection calls if they need or want us to. The next question we ask ourselves is, will our client's customer pay? In other words, has our client performed? When they receive that purchase order or that contract, what did it say? And has our client fully performed? So that we could, if we needed to, step in front of a judge and say, they ordered it, we delivered it, they need to pay for it. So a factoring company wants to know that whatever product or service their client's customer is expecting, that it's been fully performed. And then the third question is, how is our customer? Do we believe in their business plan? Do we believe in management's ability to to continue to be successful or to continue to grow. Because even though our client's customer can pay and they should pay, meaning our client has performed, if our borrower isn't around, it's still more difficult to get them to pay. So we want to believe that all those questions are true. So if all of those questions are true, then our prospective client is probably a good fit for factoring. Asset-based lending is also collateral-driven working capital, meaning that we're looking at collateral and not cash flow. But in addition to those invoices that we talked about lending against, when you're in an asset-based lending facility, you might also be borrowing against your inventory, or you might be borrowing against equipment, or you might be borrowing against real estate. So it opens up to a larger spectrum of assets if you're obtaining an asset-based loan. So the criteria for an asset-based loan are a little bit different than factoring. We talked about the criteria for factoring. The criteria for an asset-based loan is a little bit different. For one thing, you need to have been in business for at least a year, because the asset-based lender is analyzing your historical performance a little bit. They want to know that you can create timely and accurate financial statements, so that when they go in and they do their field exam, which is the front end kind of underwriting that they'll do, they want to be able to tie out those books and records to GAAP. They want to look at your inventory system, your perpetual system, and say, is what's on the report actually what's in the warehouse? So they want to know that your financial reporting is accurate, and then again, they're looking at kind of future performance. Sometimes you're coming to a collateral-driven working capital provider because you're really, really growing. Sometimes you're going because you're distressed. So they want to look at your turnaround plan if you're distressed, or they want to look at your projections if you're really growing. They want to make sure that all of that makes sense. If you think about where this kind of working capital fits in to kind of the spectrum of financing that's available, bank financing is the most traditional kind of financing. Most of you have heard of that. Most of you think of that first. Banks are regulated institutions. They're a great source for working capital, but you have to be able to demonstrate historical cash flow. Pam talked about cash flow. You have to be able to demonstrate historical cash flow for the amount or the size of the working capital facility that they're providing. When you're starting out or you've hit a few speed bumps in the road, that cash flow isn't there. And so then you can look to alternative forms of working capital. Factoring and asset-based lending are in that collateral lender bucket, and they are oftentimes alternatives for companies that are either really growing or for whatever reason are distressed. The other, another source of working capital that's out there is equity. Equity can come in a small way where people run around to their friends and family and say, we've got this great idea, give us some money so that we can go build this business. Or, more formal forms of equity. In order to attract more formal forms of equity, they have to really believe in your growth plan. They have to, like we have a manufacturer that we're looking at in Iowa that has so far financed their growth with equity, but they've got about $5 million in revenue, and the equity source wants to see them get to 50 in the next 2-3 years. So they really want that really attractive growth curve in order to attract equity, but that's certainly another form of financing. A lot of times people would prefer to use a collateral lender to equity, because equity permanently dilutes your ownership. The value of a $5 million business when you need to go out and raise equity is very different than the value of a $50 million business. So you're giving up, maybe half of your business or half of that worth today at that $5 million level, when, in a couple of years you'll get to that $50 million level. So a lot of times if you can use debt instead of equity to get there, then at the end of the day, the profits from that $50 million business are yours and not the investors. So what kinds of businesses can use collateral-driven working capital? We talked about this a little bit earlier, but we have to be able to believe that we could independently step into your shoes and convert whatever that collateral is to cash. So businesses, a lot of times people say, well, who is it a good fit for? It's often easier to talk about those few kinds of industries or niches that it's really not a good fit for. And the top one will show you anything that is progress build. So if you look at a big construction project where you're maybe going to bill every week or every 2 weeks or every month for the work that you have done, the customer will not ultimately pay you until that entire project is done. So a collateral lender cannot feel confident that those invoices that you're generating for this week's worth of work, that they could actually independently convert to cash. The same thing is if you're doing something complicated, like building a really complicated piece of machinery, where you're maybe going to get a down payment and maybe you're going to build it over the course of 6 to 12 months and you're going to get progress payments in the middle. Software developer, anything that's being progress billed is not a good fit for a collateral lender. We want to know that you've built that product, that it's gotten on the truck, or that you've provided that service, that the service is complete, and that as a lender you could independently convert that to cash. We're asking that same question if we're lending against inventory. We want to know not what in the ordinary course you would sell that inventory for, but if we have our hands on that inventory and we're taking it out into the market to sell it, could we sell it and to who and at what price? So that's really what drives advance rates for collateral lenders. So we talked about this already, but so what kinds of businesses come to us? Either those really high growth emerging businesses, those startups that don't have the historical track record that a conventional lender needs to see, or a company that has hit a few speed bumps in the road and needs a little breathing space while they right the ship. They'll come to us, we'll work with them for as long as they need us to, and then they'll graduate usually back into their bank line of credit. How are these kinds of things structured or monitoring? Factoring loans are underwritten at an invoice level. So we're receiving copies of our clients' invoices. We're analyzing that. We're getting proof of delivery. We're lending against that invoice. Asset-based lending is a little bit different, where we're going out and doing field exams, looking at financial statements, tying them out to GAAP, test counting the inventory, doing appraisals on the equipment or the real estate, underwritten a little bit differently. And then on a weekly basis, our borrowers are filling out borrowing-based certificates, or more often if they're borrowing more often. So that's the way those kinds of loans are monitored. So let's talk about a couple of examples. We have a client that builds gardening products. Obviously, that's a very seasonal business, one where your need for working capital might spike and may not be supported by your historical sales or your historical cash flow. That client came to us when they had small revenue to start with. They were selling to kind of mom and pop shops. They had some online orders, and now they were getting into the big box retailers, the Costco's of the world. So they had these large orders that were upcoming. They really needed access to working capital. They did some with leveraging their own personal assets, but then we came in, provided an inventory loan to help them build inventory to ship these large orders. And then this season they were able to significantly grow because they sold to a lot of big box retailers their product. And so it was a great tool for them to grow revenue without creating any additional debt for the business or without going out and raising equity, which was their other alternative. Another client we funded recently was a printing company. They were kind of muddling along. Printing has been a really tough business for a long time because we all do our printing at our own desks and offices that we used to outsource. So printers have struggled for a really long time, and this is the second largest print market in the country. So we had a printing company that was muddling along, was going to really benefit from doing an acquisition, but their existing lender was not comfortable providing that incremental capital that they needed in order to accomplish that acquisition. So we stepped in, partnered with their bank to provide the entire facility that was needed in order to accomplish that acquisition. And in addition, because of the way that we do our monitoring, that field exam work really provided kind of confirmation to our client that the business that they were buying, that those assets that they were buying were in fact, good, that the receivables were good, that the inventory was good, because we went in and did that field work for them. Another one, a store fixture company, hit a few speed bumps because they were selling product and kind of built inventory they would supply to chain restaurants. And this one of their big clients had told them, geez, we're opening all of these stores and it's going to happen soon. And so our client kind of took the initiative and went out and built all of these fixtures for these upcoming sales. and then the upcoming sales didn't materialize in the time frame in which they thought. As a matter of fact, things that they thought that would be delivered over the next 6 months ultimately got delivered over the next 2 years, creating significant cash flow issues because, again, they already had outlaid all of those expenses in order to build that product for these upcoming orders. So that's another thing, you really want that firm contract or PO before you make a lot of investment for sales, because obviously those store fixtures that are good for this particular chain are not something that can readily be resold to someone else. They're very specific, built for this particular customer. So they were in trouble and they were struggling, and their lender really wanted them to exit their bank, and so we were able to meet with the turnaround folks that were in there, get comfortable, and really provide that working capital that borrower needed to create some breathing room until they could right the ship, and they've recently left us and gone back to their bank. So that's our role, to be in there for as long as you need us to, and then step back out when more traditional lending makes sense. Another one is a food company, again, private labeling frozen stuff for a lot of different retailer names that you would recognize. They were, again, doing an acquisition and really growing and really struggling because margins in that business are driven off commodities a lot of times, and they had kind of some fixed pricing in place for some products, and then the price of those inputs went up rather unexpectedly, and not just with one of the inputs, but really with all. So with dairy, with meat, with all of it, their input costs went up. So they were struggling a bit, but had a lot of upcoming opportunity, and so again, we stepped in, provided them the working capital that they needed to create that breathing room, grow revenue, and get back on their feet. Questions? I will be in the back afterwards. If anybody has any particular questions about their particular situation or just in general about this kind of financing. Another alternative I didn't talk about is economic development dollars are sometimes another option or alternative working capital for businesses that are starting up or growing. But that's all I've got for you.
Thank you.
Mm-hmm.